Let's continue on and wrap this week. What we're going to do is start with the poll. We always have a poll running on our StockCharts TV live stream on our website, also on our YouTube channel, other social media. We'll distribute that as well. Appreciate you answering the poll anytime you see it. Helps us to have a good dialogue about the markets together. What we asked you recently, which of these ETFs do you think performs best through year end 21? And the choice was U.S. stocks, global developed stocks, or EFA, and global emerging stocks, EM, or $EEM. So three ETFs, the spiders, EFA, or EM. 71% of you answered the U.S. market, the SPY. Only 13% said EFA, 15% said emerging markets. So pretty much 70-30 split between U.S. and non-U.S. You know, we've talked about the strength in the dollar and how that's emerged. You know, going quickly to the chart of the dollar here. You know, the strength in the dollar is really the story there, I would argue, right? The U.S. outperforms or tends to outperform when it's a stronger dollar environment. This period, especially last year, we had the weaker dollar. It's tough to really justify. That's a huge headwind for U.S. outperformance. And you saw EM and others, emerging, pun intended, with some renewed strength. That's changed, though, as you've had this bottoming process in the dollar that's really been going on for quite a while. But especially the rotation higher here in the last 6 to 8 weeks. That's where we've really seen the ratio of U.S. versus the SPY versus ACWI or something, which is a global index. You can really see the rotation out of the non-U.S. markets and into the U.S. markets. And I think that is a justifiable answer. I probably would have voted about the same thing. Let's continue on with our Wrap the Week segment. So what we love to do is focus on a couple things. Number one, we'll focus on what happened with the markets actually today. We'll take a step back and look at the weekly returns. Then we'll finish off looking at the Mindful Investor live chart list to break down some of the major themes with price, breadth, and sentiment. So earlier in the day here, as I was writing a note to my own clients, we were talking about the distributive pressures, right? That the one thing we've not really seen is a broad distribution in price on the major averages, but all the other signals, I would argue, of risk off have been played out before this week or into this week. And it was enough for me to, have more of a bearish title to the report and everything. And when I'm looking at the chart of the S&P 500, you can see midday still sort of choppy, right? We opened higher, but sort of traded lower, but it really accelerated to the downside in the afternoon. You could see a clear rotation from more rotational to more defensive. Utilities, the number one sector, up 1%, while some of the cyclicals like financials, materials, and energy really dragging down. And it wasn't just growth versus value, because the value stuff, things like financials, materials down, but also some of the more growthy sectors like technology, consumer discretionary down as well. So this was much less about growth or value. This was much more about risk on versus risk off, and people rotating away from sort of the offense of the market into more of the defense of the market. So the S&P finished down 0.75% to 43.27. The NASDAQ 100 about the same. There's no real difference between those two. Mid caps and small caps pushing further to the downside, with the small cap index, the S&P 600 down the most, about 1.4%. The VIX is back above 18, which it's been below for quite a while now. Looking at some other asset classes very quickly, interest rates actually bounced out of the open, but settled right back down, with the 10-year yield settling in right around 1.3% at the close. The dollar index up just a bit, but not too dramatically. Other asset classes, you actually saw a rotation away from precious metals as well. So again, this is where I caution people to not oversimplify. We love to think, isn't gold a safe haven? So if stocks come down, then gold is probably going up, because that's where people would rotate to. Not necessarily, and I can show you plenty of times where that actually happens and plenty of times where it does not. Today is one where it did not. So the GLD was down about 1%, silver down 2.5%. Commodities overall sort of mixed, though, with some of them rotating back to the upside. Cryptocurrencies did continue to be incredibly volatile, but Bitcoin actually finishing in the positive for the last 24-hour stretch, just below 32,000 right now, and Ethereum flat for the day. On the sector side, just very quickly, as I mentioned, this is very much a risk off over risk on, with utilities, consumer staples, real estate, all positive today in the top four. Healthcare also in the positive, and the offense, the things that you would be buying into, expecting the next leg higher, really feeling the weight today. So it was certainly a move more toward the defensive side of the coin. Let's look at the 1 week returns here. So we're actually taking it from last Friday here from the 9th, and we're looking at the next 5 trading days, and let's look what happened here. So in black with the S&P 500, which finished the week down about 0.9%, almost exactly the same return to the NASDAQ 100, which was in a very similar pattern, closed the week down 1%. 3 things underperformed this week. It was the crude oil down 2.5%. We're using the USO for that. In purple, we have small cap stocks down 5%. We're using the IWM, the Russell 2000 ETF for that one. And then at the bottom in blue, we have Bitcoin, which finished down 5.6%. A couple things outperformed stocks again. The S&P was down 0.9%. Flat for the week, just above the zero line, was emerging markets, the EEM, which was up 0.1%, also up 0.1%. Gold using the GLD. In green, we have the dollar up 0.7%, and the best of the bunch, bonds up 1.2%. You know, it's interesting, when we were talking with Christopher Mullen yesterday on the show, which is a great discussion. I'd encourage you to go check that out if you missed it. But we talked a lot about stocks versus bonds, and it was interesting as he was pointing out the stock to bond ratio really starting to favor bonds in recent weeks, and what a difference that chart has made. I mean, because really starting at the March low, it's been stocks over bonds by any stretch of the imagination. It's actually on the Mindful Investor Live chart list. We could actually go right there. Here we go. You know, if you look, this is what the chart has looked like for the last couple of years. Start the clock at the March 2020 market low, and with a couple pullbacks along the way, overall, it has clearly been favoring stocks over bonds. Really accelerated there in the fourth quarter of last year into the first half of this year. And that's obviously bond prices coming down, interest rates going higher as the 10-year hits 175. That's what is the underperformance of bonds versus stocks, and the index is making new highs, is what causes that ratio to go higher, which makes you think as an asset allocator, you're really not getting a lot by having exposure to bonds. And so that whole 60-40 split equities to fixed income hasn't made a lot of sense, because the returns have come all from the equity side of that scenario. Now all of a sudden we're starting to see the benefits of the fixed income exposure, with rates actually able to come back down a little bit, with bond prices actually starting to rally here. And a couple months ago, you had the bullish momentum divergence on things like the ag and the TLT, causing the prices to come higher. It's causing yields to come down. And you can see that now the ratio turning downwards is favoring bonds, favoring the TLT over the SPY. I think this is a key chart to be watching over the next month or two, as we're in now really the meat of the seasonally weakest part of the equity annual calendar. You continue to see stocks underperforming bonds, and if so, think about how you're getting exposure to that relatively defensive part of the market. Let's continue on. Just look at the Mindful Investor Live chart list. So as a reminder, if you've not seen our Friday show before, we always spend some time looking at this group of charts. You can access this as part of your StockCharts login. Just go to the Articles tab, and you'll see on the upper right, there's a little link from my blog, which is called The Mindful Investor. At the very top of that page, you'll see a gray button for this live chart list. You're welcome to access it right from there. The market trend model, as we often review, is using weekly data, using exponential moving averages based on that weekly data. The long-term model has been positive since June of last year, so now over a year, almost 13 months actually in bullish phase, which is totally appropriate given where we've been. My medium-term model actually turned negative in mid-May, which has been tough to digest, as the S&P and the NASDAQ have continued to make new all-time highs. The FANG stocks have broken out to the upside, although that may be in question now. But what that basically tells me is it's a general risk on versus risk off. When that turns negative, that tells me to think more about potential downside than potential upside. It doesn't tell me to try to sell charts like MCO or American Express or Facebook or any of those that are sort of in consistent uptrends that are pushing higher and higher. It tells you to watch out for things that are no longer going up and make sure that you clearly define your risk. And for things like cyclicals that have broken down, the banks and others that are breaking below their 50-day and continuing to push lower, that's what the medium-term trend model being negative tells me to focus on. The short-term model actually finished the week net positive. It was really, really close, and I was curious if it was going to give a negative signal. It really didn't. It's been negative only 1 week out of the last probably 4 to 5 months. So overall, it shows you the strength that we've seen up until today. The daily chart of the S&P, let's spend a moment here. So it's interesting that the S&P made new highs first week in July to the second and third week in July, where we're at now. You can see a bit of a bearish divergence there, not a huge one. I think the ones that you saw in April and January, a little different in terms of indicating a momentum structure over like a 3-week period. We weren't quite long enough, I think, to be similar to that. But regardless, we're seeing distribution for now. The Nasdaq, by the way, clearly in the overbought condition, and now just coming out today from yesterday into today, coming out of that overbought region, which really suggests a pullback imminent. If you look at the chart of the S&P, there are two things that I've been paying attention to very closely. One is a trend line using the October low and the March low. That connects very well with May, connects well with June because we broke below it and then traded right back up. We lined up with there in July. We've now tested it yesterday and have now closed below it for only the third time since back in November, really back here in March is when I first drew this particular trend line once we had that secondary low. So we've only been below it a couple times here. And so I think leading into next week, that's certainly starting next week in a position of weakness. Now that we've closed below there, the very next thing you look for is follow through. Every other time we've broken that trend line, we've very quickly traded back above it. My question is, do we get that sort of positive bounce, much like we did back here in mid-June? If not, you have to start looking at the 50-day moving average, which is currently around 4240. Now that has been the line in the sand for the S&P 500 going back for the last 8 months. It's broken below that 50-day a number of times, never closed below it more than 2 days in a row, going back to last October. So I think 4240 is really the first line of defense here, the first level to look for. Going into next week, that's where I would be keying in on. If that would fail, we need to look at the swing lows from June and the swing lows from May. And I think 4050, based on my own analysis, but also based on conversations with guys like Chris this week, who else did we talk to? Larry Tentarelli earlier this week. We talked about that 4050 level. Mark Newton, if I remember right, keyed in on that same level. I think a lot of us are keying in on those May lows, which tells me if we break below that, that is where you could see a real extended decline, right? At this point, that's like a 7% drop on a lot of charts. That's not the end of the world. That's a decent pullback. You break below that, though, and all of a sudden this can start to feel like a much deeper and more painful correction. We only have a few moments left here in the Wrap of the Week segment, so I just want to touch on a couple quick things. This measure of breadth, we've looked at a number of times. The S&P advanced decline line going higher. None of the others confirming the new high in the end of June into July, and two of them now breaking down and breaking below their 50-day moving average, breaking below the June low, including the NYSE advanced decline line, which I would argue is the most important. So you have this traditional topping pattern where the breadth is not confirming the most recent upturn, and now you're starting to break down those breadth measures as well. I would argue that's sort of a negative connotation going forward. We talked about bullish percent indexes a lot recently, sort of boiled up here, and the fact that the bullish percent line on the S&P broke below the 70 level, I think, is very, very key. I'll be looking to see next week if we continue to go below there. The real signal that that differentiates a garden variety pullback versus something deeper and more painful in terms of price and or time is this indicator getting below 50%. That would be quite a move from here to get that to be triggered, but that's what I'll be looking for next on this particular chart. We need to take a quick break. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.